Are traditional expert calls in the investment world becoming obsolete? According to Stream, they are, and you can access primary research easily and efficiently through their platform. With Stream, you'll have the right insights at your fingertips to make the best investment decisions. They offer a vast library of over 26,000 expert transcripts powered by AI search technology. Plus, they provide competitive rates on expert call services, and you can even have an experienced buy-side analyst conduct the calls for you. But that's not all. Stream also provides the ability to engage with experts one-on-one and get your calls transcribed free of charge, all for 40% less than you would pay for 20 calls in a traditional expert network model. So if you're looking to optimize your research process and increase ROI on investment research spend, Stream has the solution for you. Head over to their website at streamrg.com to learn more. Thanks for listening, and we'll catch you next time. All right. Hello, and welcome to yet another Value Podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could rate, subscribe, review wherever you're watching or listening to it. With me today, I'm happy to have on for the second time my friend, Mordechai Yavneh. Mordechai, how's it going?
Good. Thank God. Good to be here.
It's great to have you back on. I'm really excited for today's podcast. Before I get to it, let me just start with a disclaimer. Nothing we talk about on this podcast is investing advice. Everyone should consult a financial advisor. Always true. The stock we're going to be talking about today it's domestic listed, but it's foreign exchange. And as we're going to talk about, it has one of the wildest legal situations I've ever seen. So everybody should keep in mind that comes with a little bit of extra risk. That disclaimer out the way.
Also.
Say again?
Not legal advice also.
Not legal advice. You're not a lawyer, are you? I'm
no. I'm a lawyer at all.
But down out the way, the stock we want to talk about is Silicon in Motion. The ticker is SIMO. Longtime listeners of the podcast might say, hey, Mordecai's on talking about SIMO. Am I having deja vu? And the answer is yes. Mordecai came on in December and did a great pitch for SIMO. The pitch, I was rereading the transcript and re-listening to it. It actually holds out, especially the fundamental side, holds up pretty well today. So I'll include a link to that in the show notes. People should go maybe listen to that for some background. But Mordecai, the reason we're having you back on is because SIMO, when we were talking about it, they were in a deal to get bought out by MaxLinear. Over the past month, the deal with MaxLinear has kind of fallen apart in epic, very bitter fashion. And I think there are two things we can talk about. We can talk about fundamentals, do an update on fundamentals, but what we really want to talk about is start by talking about the legal case and this evolving, really unique legal case. So I've rambled a lot. I'll turn it all over to you. Why don't you give a little background on what's happened since the December podcast we did?
Okay, so let's just give a background for the legal case for those who aren't necessarily familiar with Silicon Motion. Back in May of last year, May of 22, MaxLinear agreed to buy Silicon Motion, most of it with cash, $93.54 a share in cash, and a little bit of MaxLinear shares, 0.388 shares. Comes out to, depending on exactly where MaxLinear is holding it day by day, about $102, $103, $105 a share or whatever. So the big holding, the big thing that was holding up the deal from being concluded was Chinese government had to approve it from an antitrust perspective. There wasn't really any true antitrust issue. The MaxLinear and Silicon Motion didn't really have any crossover in their markets, despite the talk of synergies, as you have to talk about in every merger. Silicon Motion does NAND flash controllers, MaxLinear does zero NAND flash controllers, two totally separate markets. Wasn't really much of an antitrust issue, but tensions between the US, Taiwan, and China. Silicon Motion is a Taiwanese company trading in, and MaxLinear is an American company buying a Taiwanese company in the semiconductor industry when tensions between China, Taiwan, and US about semiconductors specifically are at all-time highs. So there was a concern that the Chinese antitrust regulators would not approve the deal. And it dragged on for a while. They had to be filed. The clock was stopped, started over again. And then out of the blue, on July 26th, about 2 weeks ago, we got the news. The Chinese government is willing to approve it with the customary conditions of continuing to serve the Chinese market, fair, reasonable, and non-discriminatory manner, not including any malicious software in chips being sold to China. Okay, keeping your present Chinese employees in China, keeping your Taiwanese research and development in Taiwan, all regular, normal conditions that are expected in such a deal. Nothing, no deal breaker of any sort. Stock zoomed from where it was holding. There was a huge gap between the stock price of about 50 and where the merger terms were of 105. mostly because the market did not expect China to be approving. Then they approved. It zoomed up 75% in one day to about $93 a share. Then a few hours later, MaxLinear announces, oh, we're terminating the deal. We're terminating the deal. Stock plunges back down. Actually doesn't plunge back down as far as it started. It was up for the day. I guess the market felt that the Chinese regulators giving approval was less likely than Silicon Motion winning a lawsuit with MaxLinear, or maybe, I don't know what the market thinks is hard to know.
we can talk about that, but I do just want to jump in. It was and I was on a baby moon in Europe with my wife, and it was one of the craziest trading days because, we're over there and we're like doing dinner or something. I'm like, oh my God, like I can't believe SIMO MaxLinear is actually getting improved. The stock's up 80%. The spread is collapsing. I'm having people telling me this is the best spread I've ever seen. Like all the conditions are cleared. This is going to close next week. And then out of nowhere, the deal breaks. So it goes from up 80 and all of a sudden it's down like 40, it's up 20 on the day. It was absolutely wild. It's one of the wildest things we've ever seen.
Absolutely. I feel bad for anybody who came in at 93.
I know one person who's going to be listening to this podcast who did, and he'll probably know I'm thinking of him when I say that.
Yeah, and then there are a bunch of people who sold at 93, which probably made sense in terms of the you got most of your premium that you're looking for. It didn't really necessarily make sense to stick around for the last few dollars. I unfortunately was not one of them. I wasn't working that day, so I missed it.
Anyway, let me get us back on track because we're reminiscing about wild days. So at the end of that day, Samir has cleared this. This is ready to be done if MaxLinear is willing to say it. And MaxLinear at like 3:30, they come out with a press release, they come out with earnings, they say, we are not closing this. We think, and they throw the book at SIMO, but basically they say, we think SIMO has suffered a material adverse event. People who remember the Twitter deal will be very familiar with material adverse event. They think SIMO has suffered a material adverse event. They have breached some of the closing conditions. And because of that, not only are we not closing, but we don't even have to pay them the break fee that we would have owed them if the deal had been blocked by the China regulators or couldn't close for some reason. So we are walking away scot-free, and they have their earnings call, and they say, a person even asked them, hey, what are you going to do with the break fee? And they say, well, it's probably going to be a legal situation, but we think they suffered a material adverse event. We're walking away scot-free. So that's MaxLinear's standpoint. Maybe we can talk about what SIMO comes out with.
Right. So basically, they said that they had 4 reasons why they were able to back out of the deal. They said 1, certain conditions of closing were not satisfied, not capable of being satisfied. 2, material adverse event, like you said. 3, that SIMO was a material breach of representations, warranties, covenants, etc. And that the original date for closing the merger was supposed to be extended 2 times, but after the first extension on May 5th, they said that it did not automatically get extended because conditions for closing weren't capable of being closed. So it was outside the last date for the outside date for closing anyways. The second outside date, which was the final outside date, was August 7th. So they terminated the deal about 2 weeks before they were supposed to close. So Silicon Motion came back and said that this is all nonsense. They actually wrote a very strong letter yesterday, which I have it right here. Actually, it's written in a very very down to earth method. MaxLinear's supposed grounds for terminating the agreement are baseless and sheer fiction. It is obvious as manufactured excuses to try to get out of its binding agreement. MaxLinear's wrongful termination is a willful and material breach, and we will vigorously pursue all remedies, including but not limited to the right to hold MaxLinear liable for substantial damages.
And I think one thing, I can't remember if they allude to it in the letter or not, but one thing they say is like, look, hey, if we have suffered a material adverse change, not so much, but if we've breached the merger, we have 30 days. You have to alert us, right? People who are, again, if you remember the Twitter deal, Elon alerts them, files an 8K or it files an attachment to his 13D in early June that says, hey, you are in breach of the merger. You have 30 days to cure this breach. If you don't, then I can break the merger. But if you do, then the merger is kind of back on, right? And one of the things I think SIMO says is, hey, MaxLinear, you could have filed that we were in breach of the merger a month ago, 2 weeks ago, whenever, and then we would have had 30-day security and then you could break it. You didn't file it. Like, it's clear that you guys kind of were thinking, oh, I hope China doesn't approve this and then we can break the merger, but you never filed that we were in breach, so you didn't give us a chance to cure. Sorry, go ahead. I was rambling.
It's more than just, you didn't, even when you file that you're in breach, you can't just send a letter like what MaxLinear did, you're in breach. You got to say what is the breach. You're supposed to be, it's even spelled out in the agreement that you have to send a letter that explains the basis for why you say there's a breach. I mean, whatever you think about Twitter's Elon Musk's invented reasons not to have to buy Twitter, but he invented the reasons and he spelled them out. They were mostly nonsensical, but there it was. It was too many bots. It was foreign intelligence agencies that have infiltrated Twitter. Whatever the reasons were, he spelled them out, and these were the reasons why he felt he could back out. Here, they're basically just cut and pasting all reasons given in the merger agreement that allow MaxLinear to back out. They're cut and pasting that terminology without giving any reason for it. You can see that even when they say that Silicon Motion breached representations, warranties, covenants, and agreements. Well, which one? Did they breach a covenant? Did they breach a representation? That's not the same thing at all. It sounds like you just cut and pasted. Any of these things would be sufficient, so they breached those. And there was material adverse event, and we're outside the date, and the conditions were unsatisfied. Those are the 4 reasons given why we're allowed to back out. Well, all 4. What are you talking about? Don't know. And they don't know either. They just cut and pasted the language. It's unquestionable that it is sheer fiction and baseless. I don't have any private information about what's been going on, but there's very little Silicon Motion could have done to breach the deal, the breach agreement. They basically have to be working towards the closing. We're working towards the closing. They got the governmental approval. They wouldn't have been working for governmental approval. That would be breaching the agreement. But they worked to it and were successful at it. They got all the deals needed. There was nothing left to do. They didn't go out and buy another company. They didn't sell off part of the company. There's clearly nothing obvious to say that they breached any in a material fashion.
They weren't counting all of their bots as users. I don't know. Like, at this point, let's just throw that one in for all time.
They didn't actually claim fraud. That's one thing. They didn't actually say, "Oh, and all your revenue is fraudulent." They didn't throw that one in. That would also get them out of the agreement. They didn't claim that. And it's ridiculous. No one thinks. Every third-party observer on here understands that it's basically buyer's remorse. Buyer's remorse because because Silicon Motion stock has come down a lot, and the whole industry is suffering through a downturn. And buyer's remorse, probably more importantly, because MaxLinear is suffering.
Yep.
The same way the rest of the semiconductor industry is suffering. They're suffering. Their last quarter pushed them into a loss. And then operating loss. Silicon Motion is still profitable. MaxLinear is the one that this downturn has pushed into a loss. And that, combined with the huge rise of interest rates, they were going to borrow $3 billion from Wells Fargo et al., other banks, to close this deal. They're paying SOFR plus 3%. So originally, maybe that would be, let's say, $110 million a year. And now we're talking about paying $250 million a year of interest. I think that's probably the most important reason why they're looking at this $250 million a year for during a downturn. Can we even afford it?
It's not just that, like, if you go, when they announced this deal, if I remember correctly, the deal was announced late 2021, early 2022. MaxLinear's enterprise value is about $6 billion, right? So this is a levered buyout. They're paying $3 billion plus a little bit of shares to go buy Silicon Motion, but there's $6 billion. Obviously, Silicon Motion has value, but it's a leverage play. Today, as you and I are talking, MaxLinear's enterprise value is under $1.8 billion, right? So it's not just that. I agree with you. They're forecasted, and again, they'd have Silicon Motion in there, but they're forecasted to do $160 million of EBITDA this year. If you think about throwing $250 million of interest expense in there, like, that's terrible. But it's also, hey, they were going to go borrow more than their enterprise value to buy Silicon Motion at this point. Like, the math's really changed. I heard Wells Fargo was probably looking at $1 billion loss on the loan that they were going to do to MaxLinear. So I think MaxLinear, they were really praying, if China blocks this, we can pay the break fee and walk away. But when China approved it, it's the worst day they've ever had. And they say, oh crap, like, we're going to have to leverage the whole company to buy SIMO, like, at the absolute downturn. This is going to be awful for us. Let's just take a Hail Mary and try and get out of this thing. Very, again, very similar to Elon signing at 54 and the whole tech industry melting down and him saying, oh my God, Twitter might not be worth 20 as a standalone.
Right.
So go ahead.
It seems obvious that push comes to shove, MaxLinear does not really have the right to terminate. So that might make you feel all good and moral and the high ground as a Silicon Motion shareholder, but I regret to tell you that I don't think that will get you all that much. So where does this go? So people are comparing this to the Twitter saga with Elon Musk, and there's a few major differences. The biggest difference here is that Elon Musk and Twitter went to Delaware courts. Delaware courts are famous or infamous, depending on how you look at it, for their super speed. It was everyone who was familiar with the topic understood that this was going to take place 6 months at the outside. The whole Twitter saga would be over one way or the other, even with appeals, etc. In the end, it took 3 months, maybe a little less, and it was done. This is not going to Delaware courts. This is going to Singapore arbitration under the SIAC, using Cayman Island laws and using Delaware law to define what a material adverse event is. So that just it sounds like some amalgamation of everything there, but the basic point is it's going to Singapore arbitration. That's not happening in 3 months. It's not happening in 6 months. If you look on, look up Singapore's stats, they'll tell you that they finish arbitration within about 15 months from when arbitration is filed. I'm here to tell you that number is also underselling it. 15 months from when arbitration is filed, that's their average. Most of the cases they're seeing are $15 million cases, $20 million cases, $50 million cases. The biggest case they took in 2022 was a $600 million case. This is a multi-billion-dollar case. It's definitely going to be on the higher end of how long things take. We're probably talking a minimum of 2 years. At that point, are we suing for specific performance? The world will look different in 2 years. I don't know if MaxLinear will be capable of buying them for 102. I don't know if the shareholders. I would be very disappointed if in 2 years the shareholders will still be looking for MaxLinear to be buying them for 102. I would hope that Silicon Motion would be significantly higher by then. So I don't think we're actually looking to sue MaxLinear to actually close. I think that's not really in the cards. So what are you talking about? So termination fee, $160 million, that they should be able to sue for 2 or 3, whatever it is, years down the road. They very likely will be able to get a judgment for at least $160 million. What's $160 million? It's $5 a share. Yeah. So it was supposed to go for 102. Now it's trading for a little bit under 60. You get $5. Not nothing. I'll take $5, but that's just not really compensation. So I see, watching people online and different people who texted and emailed me and whatever.
Look, I feel like you're calling me out because the moment the deal broke, I sent you a message that said, "We've got another MAE. Let's go." It's Twitter all over again. I know you're calling me out, but that's okay. I appreciate you not doing it directly.
Not just you. I do talk to other people also. Anyways, so the merger agreement does state that in cases of a willful and material breach, damages are not capped at the termination fee. In all cases, damages are capped at termination fee, except in situations of a willful material breach, which is specifically, if you're paying attention, Silicon Motion has been underlining that this is a willful and material breach. Absolutely. And again, I think it's clear that in basically any arbitration court of law, that's what they're going to decide, that this is a willful and material breach. But that doesn't get them as much as you think it would. People are probably expecting to say, listen, August 7th is when they were supposed to close. At that point, if they would have closed, shareholders would have gotten $102.45 a share about. Instead, the shares on August 7th closed at about $61.50 or something. So the differential is about $41 times 33 million shares outstanding, $1.4 billion of damages, uncapped. And that sounds like the best of both worlds. We'll get the $1.4 billion cash, keep the company. I mean, they can't actually get $1.4 billion of cash simply because MaxLinear doesn't have that money.
So say that MaxLinear, yeah.
Such a damages award would push MaxLinear probably into bankruptcy. If they have $400 million of debt plus $1.4 billion a legal award against them, they probably go into bankruptcy, get something out of it, share with other creditors or whatever it is, unless there was some massive upturn in semiconductor industry, like really massive, because MaxLinear is probably over levered for the size of the company. I don't think you'd actually see 1.4 billion. Let's say we'd walk away in the end with $500 million worth of cash or shares or something from MaxLinear. Sounds like a nice outcome, and you keep your Silicon Motion. Best of both worlds. Unfortunately, it is not so likely that will happen. And the reason is because we have to keep in our head the difference between company and the company shareholders. The shareholders suffered $1.4 billion of damages. The shareholders are not parties to the merger agreement. The merger agreement is between Silicon Motion and MaxLinear. Silicon Motion didn't lose $1.4 billion because they weren't going to get $1.4 billion. In the merger agreement, clause 8.8 says that there are no third-party beneficiaries created by anything in this agreement, except for the banks for certain clauses, but otherwise no third-party beneficiaries. This has been litigated not so many times. It's been litigated in New York. In 2005, the famous Consolidated Edison case was supposed to, Con Ed was supposed to buy Northwest Utilities. They backed out from the merger. Northwest Utilities sued them for the difference in what they were supposed to get and their trading price. Northwest Utilities shareholders sued Con Ed. Two different suits, went through court, went to Second Circuit. Second Circuit ended up ruling no third-party beneficiaries. So in the merger agreement, you have no rights for damages for the difference in price. The damages you can get are the amount of money you spent on trying to get the merger closed, your legal fees, that type of stuff that you spent in working towards a merger and they backed out on you. That's your damages, $25 million. Here.
And now, a quick word from our sponsor. Are traditional expert calls in the investment world becoming obsolete? According to Stream, they are, and you can access primary research easily and efficiently through their platform. With Stream, you'll have the right insights at your fingertips to make the best investment decisions. They offer a vast library of over 26,000 expert transcripts powered by AI search technology. Plus, they provide competitive rates on expert call services, and you can even have an experienced buy-side analyst conduct the calls for you. But that's not all. Stream also provides the ability to engage with experts one-on-one and get your calls transcribed free of charge, all for 40% less than you would pay for 20 calls in a traditional expert network model. So if you're looking to optimize your research process and increase ROI on investment research spend, Stream has the solution for you. Head over to their website at streamrg.com to learn more. Thanks for listening, and we'll catch you next time. Can I just push back there? It is unquestionable. You and I as SIMO shareholders cannot sue MaxLinear and say, hey, we would have gotten 100 or stock's worth 50, give us 50. Unquestionable. If I can just put back this, so I hear you, like, in this case, specific performance, which would be the deal, close the deal, is not available to us. I know there's a merger cap, as you said, except for willful breach, which I think this willful breach.
Not available to us. You could go for specific performance, and if 2 years down the road, Silicon Motion is trading at 10, they can still be suing for specific performance. And if MaxLinear financing is not a condition to the agreement, but MaxLinear has to practically be able to get the financing. If 2 years down the road, MaxLinear is doing well and Silicon Motion is doing poorly, you could still be suing for specific performance, and you could probably get it. Yeah, I just don't know how likely that's maybe an option in the background. But I don't know how likely it is that practically specific performance is what we'll still be asking for in 2 years, and that MaxLinear will actually be able to do it.
Yeah, I mean, one thing, and we'll talk about this in a second, is there are branches of this where Silicon Motion sues MaxLinear, wins specific performance or $2 billion or whatever you want to call, whatever comes out, and MaxLinear has to file, and Silicon Motion has to take them out of bankruptcy as their largest unsecured
creditors. Not specific performance. Specific performance can't get them to bankruptcy. If you're suing for specific performance and they can't do it, so they can't do it, then you can sue for damages. How much damages do you get?
Well, you would get the specific. Yeah, I do hear.
No. You do not get the difference in price. That's not what specific performance means. You can sue that they should do what they said they would do, and you can win that lawsuit. If they can't do it, then they can't do it. Now you can sue for damages.
Yes. And
the damages is what we're talking about. And this is called shareholder expectation damages. And the Second Circuit of the United States has ruled that shareholder expectation damages are not valid in a merger agreement where it says no third-party beneficiaries. Now, is that absolutely clear? It's not absolutely clear. That's the Second Circuit of the U.S. A similar court in Ontario, this was in 2005, was the Second Circuit. In 2021, in Canada, Sign World was supposed to be buying Signplex, and they backed out because of COVID. which was not a valid reason to backing out. Actually, pandemics were specifically carved out as a reason in the merger agreement, even though it was signed in 2019. They luckily carved that out. Simplex sued World. It came to court in Ontario. The court ruled that they do not get damages for the loss, the premium loss, because that is not a damage of the company. They do get damages for lost synergies, which they awarded Simplex $1 billion for. World is now in bankruptcy. That's being appealed, but they got money for lost synergies, not for the premium. They specifically ruled that they cannot get the premium because no third-party beneficiaries. Now, they could be going for lost synergies, but the lost synergies here is not going to be $1 billion. The lost synergies in the prospectus, they predicted synergies of $100 million. And part of that probably accrues to SIMO, part of it probably accrues to MaxLinear, and between you and the lamppost are probably all fake. I don't think there's any synergies really. You get synergies maybe in your accounting department. I don't think there are $100 million of synergies. Certainly not more than that. And it's the type of thing that's very hard to prove a high number for loss synergies.
Let me just back up. So in your scenario, if we go 2 years down the road and rule specific performance, and MaxLinear says we can't close specific performance because we can't raise the financing, right? You're telling me that SIMO would just have to walk basically because MaxLinear can't close anymore.
Would they be able to sue for damages?
But the damages would be you have to close this, right?
This is two different things. Specific performance is to do what you said you do. Damages is monetary compensation for the fact that you've reached the agreement.
Specific performance
is not damages. Specific performance is performance.
So specific performance you have to close. So MaxLinear would have to say we can't close, and then they would have to file, right? Wouldn't they have to file?
File for what?
File for bankruptcy.
They don't owe any money. They owe 90. They can't close. What do you want me to do?
They owe $92 per share.
No, they don't. That's not what. That's not, specific performance says I have to close. I cannot close, so I'm not closing because I cannot.
But
I don't owe you $92 a share. I owe you that you have the right to force me to buy you. You can try to force me to buy you. I cannot do it.
But that's why I think they would have.
I don't owe you money. I do not owe you money. I owe you to buy you. Buy you means give you money and get shares. I cannot give you money and get shares because I don't have the money. Therefore, I am not doing what the court ordered me to do because I am force majeure, not able to do it. Maybe my fault, but I cannot do it. So I'm not in contempt of court or anything. I cannot do what the court told me to do with the arbitration tribunal in this situation. At that point, you can sue me for damages. Give me money in place of the fact that you did not do what you agreed to do. That's monetary damages. And the monetary damage would not be be unlikely to be $1.4 billion. The Second Circuit would not give damages for that, and the Canadian court wouldn't. Delaware courts, interestingly enough, might. It's very much up for grabs. I don't know how closely you but in the middle of the Twitter saga, is my video? Do you see my video?
Your video went a little strange, but I can still hear the audio just fine.
Huh. 1 second. Let me see if stopping the video and restarting it solves that problem.
There we go. Yeah, perfect.
Solves that problem, right? Turn off the computer, turn on the computer. Solves every tech problem. So in Delaware, during the Chancellor McCormick, actually, there was a side case. I don't know how closely you were following the Twitter lawsuits.
I was reading everything with the Twitter lawsuits.
So
go ahead.
Luigi Crispo, I believe, was an individual shareholder of Twitter that also sued Elon Musk. And there was a question whether he had standing to, because he was a third-party beneficiary, and the agreement said no third-party beneficiaries. And Chancellor McCormick wrote an opinion on this topic where she somewhat danced around it. She talked about the Second Circuit decision. She talked about other decisions in Delaware that seemed to say that no third-party beneficiaries does not include the shareholders. Because shareholders are obviously, yes, beneficiaries of the agreement because they're the ones getting paid. So no third-party beneficiaries means anybody else except shareholders. But shareholders are included. There were 3 different cases that she discussed. None of them were actually about getting damages for the premium loss. And the cases were not necessarily so precisely, it didn't follow from the cases that you would get the damages lost. They were more like there were post-closing conditions that somebody agreed to buy another company and then agreed after buying not to change their prices or not to do this or not to do that, and shareholders or sued over that, former shareholders. It was like a family-owned business that wanted certain things to continue. And the question was whether they had standing. The answer was yes, but who was that line written for? But that doesn't necessarily translate. And she speaks this out, Chancellor McCormick, that it's not so clear whether the Delaware precedent would allow for damages for the premium gap or not. That needs further briefing, needs further discussion. It's a question in the air in Delaware. Second Circuit wouldn't give, Canada wouldn't give, Delaware maybe or may not be. This is really not so relevant because we really want to know what a Singapore arbitration tribunal will find under Cayman Islands law.
Yep.
And we don't have any precedent that I know of about Cayman Island law or Singapore arbitration tribunals on the topic. But to me, on the lamppost, the weight of precedent of the Second Circuit and the Canada, which is directly on this, and Delaware, which is about other things and was hypothesizing what would be about this interesting question, I think it's more likely the Singapore arbitration tribunal will say, we're not awarding $1.4 billion. We'll award your damages. Your damages, definitely the $160 million termination fee. The $30 million you spent on, the lawyers and the people you paid to work through the regulation stuff, maybe or maybe not cost of the arbitration itself. Yeah. So we'll get you to $200 million maybe. That's not what anybody's looking for here.
So in your mind, the most likely outcome if they pursue this arbitration is SIMO winning and kind of taking in, as you said, call it $200 million, which kind of comes out to, if I remember the math in my head right, a little under $7 per share at the end of 2 years. You think that's the most likely outcome here?
I think that's the most likely outcome with a parenthetical option that if things go terribly for Silicon Motion and things go well for MaxLinear, they do have the option to force specific performance, and it could very well be that MaxLinear will be able to. It is unclear to me from reading through the financing commitments from Wells Fargo whether Wells Fargo's commitments will last through the 2 years of arbitration or not. There's no specific ending date in Wells Fargo commitment. The commitment is to finance whatever's in this agreement. If it's found that the agreement never terminated, it is possible Wells Fargo commitment will still be there to lend the $3 billion. Or it might be another lawsuit on the topic. Lots of fun. It's not really clear to me what I don't know of a clear precedent. That's probably me not knowing more than that there isn't any. There probably is some precedent out there that's relevant. It could be that MaxLinear will be able to close simply because Wells Fargo will still have to lend them the money. So I don't know about that, but that's like kind of an option. And that's a valuable option. But personally, if in 2 years' time we still want such a performance, I'd be disappointed.
Let me push back. So again, how I had been, and I have done work on this, but not as much as you, and I am certainly not a legal expert, but how I had been kind of shaping around to it was, you have the suit, and it's a 2-year suit. And at the end of it, if SIMO wins and gets specific performance, MaxLinear would either need to close or they'd need to file, is how I had been looking at it. And I understand what you're saying. That's just how I've been looking at it. And kind of what I had been thinking was, so you've got that hammer at the end of it. And then where you kind of come out is you have either a settlement between now and then where the deal gets recut, and basically, and this assumes a positive thing, but basically MaxLinear's breaking this was a way to force a huge recut of the deal, right? Where the original deal was something like $90 per share cash and like $18 per share in equity. You're basically coming back and saying, all right, we're going to change this deal to be $10 per share cash, and SIMO shareholders get 50% of the combined company or something.
Definitely not happening. I'll tell you why. If they raise the stock portion of the deal, then MaxLinear shareholders have to vote on it.
Yep.
MaxLinear shareholders are going to vote no. They don't want this deal. When the deal was announced, the stock tanked. When the Chinese approval came in, the stock tanked because they don't want the deal to go through. I don't blame them. I
hear you, but if they go to their shareholders and they say, look, we're going to lose an arbitration, and if we do that, we're going to have to pay $90 per share to SIMO or file, like that.
That's probably not even true, as I said.
Okay.
You might be right that they're looking to recut. I don't see a massive recut of mostly shares is very difficult. And if they recut it to let's say recut it to the same amount of shares, but let's say instead of $93 cash, $80 cash. So instead of $104, we'll bring it down to $90 a share. Yeah, you need another vote from SIMO shareholders. Don't know if that would or wouldn't go through. I voted no to the first merger, so I don't know that anybody's listening to me. Now, if we got, confirmed $90 share, it could be people who vote yes. I don't know. There would need to be another vote, et cetera, et cetera. It could be that's what MaxLinear's game here is. They're just trying to recut. It's definitely possible. It's very hard to know what's going on inside the minds of the MaxLinear management. That could be what they're aiming for. A massive cut to $60 share, I don't think SIMO shareholders are interested in, or $70 or $75 share. I doubt they'd be interested in it. And changing it mostly to stock, which is affordable, is just not happening because MaxLinear shareholders are not going to approve it.
Let me just back up real quick too, and I don't want to harp too much on it, but it's really it's really a different view than what I've had. And your specific performance case, right? Let's drop SIMO and MaxLinear from it. Let's just go to a normal company buying a normal company, right? I'm buying Mordechai Inc. Market turns on me. I get really cold feet. I say, hey, Mordechai, I'm breaking the deal. And you say, what? I followed everything. We've got a contract. You sue me for specific performance. You win. You say, great, I win. Pay me. To me,
not pay me, buy me.
Buy me. You say, great, buy me. To me, what you've created, if I don't have to, if MaxLinear could walk in this situation, what you've created is I could just say, Mordechai, I'm not buying you. And you say, okay, great. I'm suing you for expectation damages now, but because I was just buying you for
I then go to court that they'll start putting you in contempt of court for not following a court order. Well, here's an arbitration order. You have to take the arbitration award for specific performance, take that to court. The court would mandate performance. And then, listen, MaxLinear is not going to ignore a court mandated order. It's just not happening. So just like Elon Musk wasn't going to ignore a court mandated order. MaxLinear is not looking to be in contempt of court and ignore an order that they can fulfill.
But so that's why I think they need to file for bankruptcy. That's why I think they would need to
file for bankruptcy. That doesn't make you file for bankruptcy. If you can't do something, you can't do something. To file for bankruptcy, you have to have a monetary award. Specific performance is an award to do an action. It's not an award of money. Money is damages, and that's expectation damages. But expectation damages are for the shareholders, not for the company. And as I said, the Second Circuit, Canadian Circuit, and probably more, not for sure, very not for sure. The arbitration tribunal could go either way. But likely, it's definitely a strong likelihood that the arbitration tribunal would say, we're not going to award expectation damages for the shareholders that third-party beneficiaries.
I'm gonna have to do more work on this, and I'll follow up with you offline. Our listeners can either hit one of us up.
I know this is very disappointing for all the Silicon Motion shareholders out there, including myself. No, but that's what I expect. I just feel like you've created a precedent. Most of the focus here going forward should be on either the possibility that there'll be a recut and another shareholder vote, and then we're talking like recutting from 105 to 90, and it's just negotiating ploy, or I think really focus on the fundamental case, which I think is very bullish. But
I just feel like in that scenario has created a precedent where any company that cannot buy, that is in a merger contract that they cannot fund kind of off their balance sheet, has a free out by getting sued for specific performance, and then saying, hey, sorry.
Not true. In Delaware, you sue in Delaware. If you sue in Delaware, so you're talking about a 3-month process, at the end of which they already have the financing commitments, and you close because you have to.
Okay, so in this case, you're saying
it's a 2-3 year process. At the point, so yeah, maybe at the end you could get specific performance, and maybe the financing commitment is still valid, which it might be. The question is, in 3 years, do you still want the specific performance? If you do, then you can get it. That option is valuable. Again, that option is really valuable. You have the option to get super specific performance, and there's a strong likelihood that the Wells Fargo commitment will still be valid in 2-3 years from now, because it's valid as long as the merger agreement is valid. And they might claim, Wells Fargo might start claiming that the termination was terminated, even though invalidly, so they don't have the commitment anymore. It's not really clear in the finance commitment. I read through it with a fine-tooth comb. It still wasn't clear. I don't know enough about precedent on that. It could be in 3 years, Wells Fargo won't mind, financing it. It depends on what the financials then are like and what the interest rates then are like, and it could be they'll be okay with it.
Very true. I mean, this is a very cyclical industry. Boom times generally follow bust times. We're in bust times right now. Right. MaxLinear had a $6 billion market cap 2 years ago. It's very possible.
That option to sue for specific performance is actually very valuable. Right now, the stock is trading at 60. There's an option to sue for specific performance at 104. That's really valuable. I personally believe by the time that option becomes in play, the stock will be past 104. That's what I believe on the fundamental view. Let me just take out a moment. We didn't really discuss. We discussed why. I mean, they didn't really give any explanation of what the supposed breaches of warranty.
That will transition us nicely to fundamentals, because that's where I want to go next.
Event. Let's talk about the material adverse event for just a moment, because there it seems obvious that they're referring to is that MaxLinear, Silicon Motion's business fell apart. The first 2 quarters of this year, revenue's been down 40, 45%. Net income's been down 80%. Yeah, so there you go. Here's our material adverse event. That seems to be what they're referring to. So I just want to speak out, just for all our listeners, that that's not going to fly. There's really no material adverse event here for 2 major reasons. First of all, again, the material adverse event here is on the Delaware law. Delaware law is very clear, very specific. And Delaware law, they used to say that Delaware has never found a material adverse event in history. A few years ago, they changed to a material that they've only once found a material adverse event in history. Basically, the law is like this. Delaware says to be a material adverse event, you have to have the business collapse on a permanent basis. So the one time they found a material adverse event was the company that was being bought had defrauded the FDA and made up all the clinical trials, and their revenue disappeared, and with no foreseeable reason to think that would change.
It was Acorn Fresenius, and if you remember, Acorn made sterile eye drops, and they literally had Fresenius in their suit. It came out that Acorn literally had cockroaches running around their sterile eye drop facilities, and like cockroaches running around your sterile facilities. It's not a merger contract, but I use it to say like how bad the business was that they were buying.
And I believe they actually made up clinical trials in their made up data in the clinical trials that they submitted to FDA. It was a terrible situation. The revenue fell off the cliff and it wasn't coming back. That was a permanent MAE. What's not a permanent MAE? Example, I forget the name, but one of the private equity firms contracted to buy a cake business. Then came COVID. Cake business, wedding cake business, I believe.
Colbert K-pop, yep.
Yeah, totally fell apart. Yeah. And Delaware said that's not a material adverse event. Yes, COVID, it's not going to last forever. 2 or 3 years, COVID will end, the wedding business will be back. No revenue for 2 years is not a material adverse event. So there's
I like how you say
no way for Silicon Motion's clearly cyclical downturn to be a material adverse event. That's reason number 1. The second reason, just as important, is that these material adverse event clauses all have carve-outs. And the carve-outs generally do, and in this case do, exclude general economic conditions. And let me quote the exact term they used. Changes in general economic, business, labor, or regulatory conditions, changes in securities, credit, or other financial markets, interest rates or exchange rates, and changes generally affecting companies in the industry or industries in which a company or its subsidiaries operate in Taiwan, the US, or globally. None of such changes will count as a material adverse event. The only way such changes that affect the industry as a whole can count as a material adverse event is if it affects Silicon Motion disproportionately more, in a sense that makes it a material adverse event, but it's not. You look at Micron, SK Hynix, Western Digital, Samsung, they're all suffering. Their revenues are down 50%, 60% for their flash. Let's look at Phison controllers. Phison is probably the closest comparison to Silicon Motion's business. They sell modules of combined flash and controllers. They sell controllers. Their business, their business for the first quarter of this year was down 41%. Second quarter was down 39%. And that's the business as a whole. The controller business for itself was actually down 53%, which is more than MaxLinear's business was down. I guess Silicon Motion's business was down. So I guess Silicon Motion is actually gaining share in the downturn. So 1, it's cyclical. 2, it's industry-wide. It's temporary. It's industry-wide. There's no way anyone would consider this under Delaware law. There's no way a Delaware court would consider this a material adverse event by any sense of imagination. And even though they're not going to Delaware court, it's going to Singapore arbitration under Delaware law. I don't think there's anyone in the world that would see this as a material adverse event based on the contract as written.
My favorite tweet was somebody said, hey, if you look at MaxLinear's results and Silicon Motion's result, MaxLinear is performing worse. So there's a chance that the MAE happened. It was just on the MaxLinear side.
Yes, I saw that tweet as well.
So,
yes.
Look, I think we've actually pretty well covered the legal case. Obviously, you and I, you've done more work, so I'll defer to you, but you and I have a slight difference of opinion on the outcomes of a specific performance potential, but I think we pretty much covered it. Let's quickly talk about And there is even, again, I'll defer to you, but even you're right, I'm wrong. Like there is definitely a lot of option value to being able to sue for a specific performance.
Yes,
I love what you said. Like, cyclical business, MaxLinear could be worth $7 billion in 2 years. And you might have Wells Fargo saying, hey, we'd love to fund it. We'd love to fund this loan. This is the best loan we'll ever fund, right? So
and it's quite possible that Wells Fargo will finance it if the arbitration rules they must. It's quite likely that Wells Fargo, it's not impossible, definitely not out of the realm of possibility that Wells Fargo will, as you say, want to fund it. And even if they don't, it could be they'll have to anyways. So it's definitely optional value to that specific performance. Yes.
And as you said, there also is, like, if the damages are, let's say an arbitration is going to roll 200 million, like there is also optionality to, hey, 6 months from now, everybody might say, okay, MaxLinear says, yes, we have some tail risk from the specific performance. Silicon Motion will give you $300 million right now, walk away. So there's going to be some pot of gold at the end of the rainbow. It might not be the $100 per share. Let's quickly turn to the fundamentals. And again, I'm going to refer people to the December podcast. We actually did quite a bit on the fundamentals and what makes Silicon Motion so unique, and why, again, cyclical business. So we're in a bad cycle right now, but why over time they should be a share taker, why they should. But I just want to quickly get your thoughts on how the business is performing and kind of how you see the cycle evolving.
Right. Okay. So as anybody who's been paying attention, so the semiconductor industry is experiencing a downturn. Memory in particular is experiencing a massive downturn. If you look at the flash makers, that's Micron, SK Hynix, Western Digital, Samsung's memory division, Kokusai, which used to be Toshiba, and also YMTC, which is a Chinese flash maker. You put them together, over the first half of this year, they must have lost $25 billion plus just in the memory division. Yeah, it's huge amounts of money. What's the basic cause behind it? So let's start with taking a little bit of a far view back.
What's the basic cut? They're not pumping AI hard enough. AI hard enough, Mordechai. That's the cause.
Yes, a little bit. AI does use, an AI server uses probably 3 times the amount of NAND memory than a regular server does. So there's truth to that. But what happens like this? Everyone, if you go back 2 years, 2021, everyone was talking about the chip shortage. There was a chip shortage. Autos weren't being made because they couldn't get chips, et cetera, et cetera. Because of that chip shortage, all of these customers were nervous about not getting allocations. So everybody doubled ordered, tripled ordered. This happens all the time in the cyclical semiconductor industry, especially memory industry. People are nervous, they order, double order, triple order, quadruple order, I don't know. Yeah. Inventory starts building. 2022 inventory continues to build. And then the demand explosion of 2021 starts falling off. So the demand evaporates. We're now looking at 2022 had probably double digits down on the PC market. The smartphone market's been down. It's going to be down this year. The PC market, smartphone market, the server market, all the end markets for the memory products are all down year over year. They were thinking the good times would continue. And there was a chip shortage. So they extra ordered, double ordered the memory that needs. Now all the end users and the channel market have way more memory than they needed. So they said, okay, you know what? We don't need, let's hold off. None of this is on long-term contracts. Everybody's ordering in the quarter for the quarter. None of Silicon Motion and all the flash makers have very little visibility into that business. They're building out capacity because they're hoping and expecting for their memory to be needed more and more. But they don't actually have any long-term contracts for the memory, and they have very little visibility. Their customers can tell them, oh, we think we're going to need 20% more, 40% more this year. And then 2 months later, say, you know what? Change our mind. We don't need anything. Yeah. There's no, it's operated on a day-to-day basis. They have no visibility. They're giving you, their forecast for the year. They really have no clue. The forecasts are based. They know what they're planning to build capacity and what they're hoping the market will buy, but they don't really know what the market will buy any more than any other analyst who's trying to predict what the PC market will look like in a year's time. Yeah. So they've been building out capacity, the flash makers, and then there was over ordering, so there was too much inventory, and demand fell. Between that, you have this massive disconnect between the amount of supply that the flash makers want to provide and the amount of demand that the customers and the middle market want to buy for the customers. And this is massive disconnect. With that massive disconnect, what happens is is that people stop buying memory prices get cut massively, and they start bleeding money, the flash makers. They're bleeding money. They're underutilizing their fabs, which makes them take massive underutilization charges. So they're selling their less product at a lower amount of money, and it's costing them money to leave part of the fabs idle part of the time. So how does it correct itself? So it's naturally somewhat self-correcting. They were going to increase capacity this year. Instead of increasing capacity, they're slowing the increases and eventually cutting production. It takes time. But all the flash makers have announced cuts in the first quarter, more cuts in the second quarter. Even the lampposts are probably going to announce more cuts in the third quarter, but they're going to cut until they're confident that inventory starts to bleed dry. Inventory by the flash makers are still pretty elevated. For example, I'd say Micron said they need about $6 billion of inventory to match what would be a normal, progression forward sales, and they have $8 billion of inventory. So that's still pretty high. Yeah, you can see the inventory build on the balance sheet, and it hasn't really come down yet. But the end customers themselves and the channel market inventory is starting to dry up. There are some indications of that. It's really hard to know. Part of what's hard to know is, we can still enter recession. We haven't actually done that yet. Yeah. We enter recession. The end markets of PCs, smartphones, and servers, which right now are weak, can get weaker. Yeah. There's nothing weak enough that it can't get weaker. It could totally get weaker. Demand can continue to go down, and they'll have to cut production more. This could end up with a flash maker or two going into bankruptcy. Yeah. Somebody like Samsung that has other divisions to cover their losses in the memory is going to be stronger. Something like Micron and SK Hynix, which maybe are more memory focused, are going to suffer more. What I want to underline here in all this is Silicon Motion is suffering, as a consequence of that, less memory being bought, both because demand is down in the end market and because people have to work through their inventory. So they're buying fewer controllers. So their revenue dropped a lot, dropped in the first 2 quarters about 45%. They're still profitable. This is one of the things I love about Silicon Motion. Throughout the cycle, they are profitable. They continue to add cash to the balance sheet, no debt. They're still taking money in, less money. During the downturn, it's less money because they're selling less goods. Gross margins come down a little bit. The gross margins they've been used to are about 50 to 52% because their operating expenses and their employee base is similar, but on less revenue, so their gross margin now is down. The gross margin is the gross margins are down because their expenses are up. The TSMC's charges are up, and the assembly charges are up. The packaging charges are up, but they're amortizing that over less revenue. So the gross margin is about now 42%. Down.
Can I jump in here real quick, Mordechai? So I think you've done a great job of explaining where the cycle is and kind of what's happened over the past 6 months. Look, the cycle's gotten even worse. I just want to jump in. When I read the Silicon Motion, and part of, I think the reason Silicon Motion's stock hasn't gone back to where it was before SAMR came out, and then all this, part of it is the option, but I think part of it is also people saw MaxLinear say, hey, MAE break, we're leaving. And then SIMO put out their earnings that night or the next morning, I can't remember exactly. And I'm just reading, and here's some quotes. First half was challenging. We're optimistic the industry is well poised. Growth in the second half of the year. We expect Q3 sales will be up 15 to 20% quarter over quarter. So I want you to comment on that, but I will just say from our perspective, from a trader perspective, from an investor's perspective, I think when MaxLinear files, hey, we're filing MAE, and Silicon Motion hasn't said anything because they're getting hit with it about the same time we are, everybody says, oh my God, this business must be on fire. Things are a disaster. And then they report Q2 results that, as you said, are profitable. And they say, hey, things are actually getting better in the back half of the year. So I just was hoping maybe we could transition to you commenting on, what Silicon Motion's seen in the second half and how their business will perform going forward.
So I want to, you said from an investor's point of view and from a trader's point of view. And I'm going to split that into two because they're two separate things. The trader's point of view is probably very interested to know what's going to be quarter 3, what's going to be quarter 4, near-term results. And the answer is, I don't know. And I want to underline that Silicon Motion does not really know. They predict 15 to 20% up. They predict a stronger second half of the year. They don't really.
It could get a lot worse, though. They report at the end of July. They do have they're very near term.
1 month's worth of information where they say things are starting to firm up a little bit. But But at the end of the day, it depends on the end markets. They have
Great
no
point.
real
Yep.
visibility to their customers' customers, by the way. The end markets are not their customers. It's mostly their customers' customers. Yeah. They don't have real visibility into that. They don't know that the second half will be better. They hope and think they see beginning of shoots of some, budding of some grass coming out of the ground, that it's starting to come a little better. And that could all be true. I do not want to be in the position of telling you what the next 6 months will be. I don't know.
Great point. Yep.
I'm not a trader. As an investor, I'm going to tell you what's the next 3 years going to be. And the answer is, I don't know when the cycle will end. So far, it looks like quarter one was the trough of the cycle, and it's been getting better since. Quarter two is better than quarter one throughout the industry. And everybody's saying that they're seeing inventory levels coming down by the end market, inventory levels coming down. If there's a recession, there could be another, a double dip kind of in the end market demand. Who knows? I don't know. But I know that in 3 years, we'll be out of the cycle. The cycle has always been a down. This is the worst downturn, like Micron said, is the worst downturn we've seen in 13 years.
Yep.
So 13 years is not such a long time. This happens every 10, 15 years. It does. Yeah. And one of the nice things about it, last time we had a downturn, not nearly as bad, was I think around 2018. Then Silicon Motion had to take some write-downs on their inventory. The main reason for that is a little bit of their business model had a little bit different. They have 3 divisions. They have their SSD division, it's about 50% of the company. They have their eMMC and UFS business embedded, that's like more the smartphones, tablets, and Internet of Things type of applications. That's about 40% of the business. And then there's SSD solutions where they package flash together with highly customized, very high-end controllers, and they sell it to hyperscalers like Facebook or Alibaba, Baidu, etc. That's about 10% of the business. So 50 is SSD, 40 to the embedded, and 10% for the SSD solutions. Back in 2018, when they had to take write-downs, their SSD solution was they were buying memory, and they were stuck with video again.
Oh, there goes the video again. There we go.
I'm back again. I'm not sure what's happening today. But what happened was that they were when NAND flash started crashing in price, they were stuck with old inventory of NAND flash that they couldn't sell at the old price anymore. So that's like right now. 2 things have changed since then. First of all, SSD solutions didn't live up to expectations. It's a much smaller part of their business than it was back then. Second of all, they changed their contracts where they no longer are buying flash and selling it on. They are basically just taking it on consignment for their end customers. The end customers are ordering the flash and they're doing the packaging. So they are on most of their customers, on a large majority of the SSD solution customers, they are no longer taking the flash memory risk. It's only they only have to take a write down if their controller inventory goes down in value, and that is much more stable pricing, much more long-term usage. Yeah. So they so far this cycle have not had to take a write down. Their inventory has been getting higher a little bit, but it seems to be coming back down.
I was going to make that exact comment.
Again, the peak of the inventory compared to their sales was in quarter one, where they had like 2.5 quarters worth of inventory, which is far more than they want to have. They want to have like 1 or a little less than 1 quarter's worth of inventory. Has historically been what they had. They raised the inventory levels a little bit last year when there was a chip shortage because they wanted to be able to provide. So they also raised inventory like everybody else. Yeah. But 2.25 is way more than they need, but it started to come down. Right now, they're about 1.8 quarters worth of inventory. And if the next 2 quarters continue to raise where they're claiming 15 to 20% in sales, and the inventory comes down, they'll be back pretty soon by the end of the year to normalize inventory levels, and we won't have to even be talking about the possibility right now, which I don't think is in the cards in the cycle.
I was just going to, that was one of the things, again, when you get the merger break and Silicon Motion, they're a company that's been under contract for a year, right? They're not doing analyst calls during it. They're not doing anything. So you haven't heard, and before they report Q2, you saw, oh my gosh, inventory ramped up quite a bit in Q1. And you've got MaxLinear claiming an MAE. Like, one of the things that, to me, again, as a simpleton who's studying this company from the outside, I was worried inventory had gone from 320 million to 400, and you had a situation where sales are slowing, inventory is ballooning, they're going to have to take a huge write down, all this. And to me, one of the things I saw that I liked was hey, inventory actually went from 320 to 250. Yeah, as you said, yes, it's a little higher than we would like, but we don't have a company that's over here choking on inventory that they can't move and that's just building up and like the cycle needs to turn tomorrow or else they're going to just have to take huge write-downs. So that was one of the things that just jumped out to me. Let's move away from the current cycle. If I again, I'm a dumb outsider. 250 million in EBIT in 2021, 250 million in EBIT in 2022. If we kind of fast forward and let's say 2025, and this industry is famous for whipsawing from absolute peaks to absolute troughs, right? But 2025, we're at the mid-cycle. What do you think the earnings for Silicon Motion kind of looks like in a mid-cycle normalized environment?
Honestly, I'd be surprised if they're under $6 a share by that time. They did more than $6 a share last year, and that wasn't so. The last 2 years, they did a little bit about $6 a share. It wasn't. Maybe last year was pulling in demand from future years as inventory built, but 2021 was much more realistic. They were doing about $1 billion in revenue. Their market share has been building. Even now, I believe their market share has been building. Pfizer controller revenue is down more than Silicon Motion's. We haven't gotten so much commentary from them because we're having the conference calls over last year. They have a little bit of commentary inside their earnings release, but not much. But it does appear that they're bullish on their strong design momentum. They've been increasing from under half. Used to be their SSD business was less than half of that was OEM. Now it's 2/3. OEM business is long-term, sticky business. Once you win the slot, you're very likely to win the next slot when it's replaced, and the slots last a long time. So it's a good business to be in. How much OEMs need will depend on their end market, but it's a good business to be in. Long term, they've been increasing their market share, winning market share. So I would just say, what are the risks? Let's talk risks for a second. Yeah, they have two major big customers. I mean, the major customers are the flash makers and the module makers and the OEMs. In the flash makers, Micron is a 25% customer, and SK Hynix is a 25% customer. So Micron is a 25% customer. It's been a long-term relationship. Micron has recently gotten banned from selling into China, which is about 12.5% of their business has been banned. They do 25% of the business in China, and 12.5%, half of that business, Micron has said is subject to the ban of infrastructure buying from them. So Micron, which is a major customer, is going to be under some pressure. They're probably placed with other customers, et cetera, but they're under pressure. And SK Hynix is a 25% customer. A lot of that 25% customers, because SK Hynix recently, at the end of 2021, bought Intel's memory division. They're actually in the process of buying it. They bought it. They have some control, not full control. It's a multi-year deal, whatever it is. It's complicated. But they have Intel's former NAND division. SK Hynix famously used to use Silicon Motion for their for their EMSC division. They still do. Yep. But when they transferred to UFS, they decided to insource. And I'm sure there's some risk that they were not successful in their insourcing. SK Hynix is not a major player in the UFS business. Silicon Motion is through their Micron deal and others as well. So SK Hynix did not do well with their insourcing their own controller. I don't know if they regret it or don't. But there's some risk, of course, that SK Hynix down the road will take the Intel business and start insourcing that as well. That's a risk they always have to. The major competitors here are Pfizer and Marvell, our virtual controller makers, and Silicon Motion is, and the insourcing from the flash controller. Over time, it appears that the push to insource has been going away. I believe now during the downturn, the flash makers are even more looking to outsource. They want to cut their division expenses they don't need. They want to outsource as much as they can. So the controller division is one of the things. There's been discussion, rumors, rumors somewhat, but for the last year or two, there's been rumors that Samsung might be finally looking to outsource some of their controllers. And that's a major chunk of the market. That's 40% of the flash market right there. So that would be very important. That would be a major growth story. So there's both reward possible from further outsourcing, and there's risk possibly, especially from SK Hynix's purchase of Intel of insourcing. Last time SK Hynix insourced, there was a good chunk of Silicon Motion's revenue at the time. I think they were 33% customer. Silicon Motion grew through it and came out strong on the other side. If it happens again, I believe they'll grow through it as well. I'm not so concerned about it. I think more outsourcing is more likely than more insourcing. That's one major risk. The second thing I would highlight on a long-term basis is that Silicon Motion has yet to crack into the enterprise market. They They've been working on it for a few years. I believe this year is the first year where their enterprise controller is maybe able to be a player, and they want to start breaking in 2024, 2025 and start building up. If they're able to do that, that's a greenfield opportunity for them where they head on start competing more with Marvell, who's mostly enterprise controllers. In the consumer space, they won all that business from Marvell, and I think that they have a good chance of winning the enterprise business from Marvell over time as well, and that would be tremendous growth for them as well. So I think there's a lot of good things to look forward here. When the cycle turns, I think we're looking at $5-6 a share on a normalized basis, with the possibility of major further growth more if they break into the enterprise space. So I think that's pretty good.
And I was going to say halfway through that,
and let's not forget the amount of cash they have on the balance sheet. They're trading at $60. About $17 of that is cash and easily convertible receivables, et cetera, minus their liabilities. They have no debt. Take out all the liabilities, they have $17 left of cash and convertible cash assets. So we're looking really at a share price of a little bit more than 40 on something that down the road, I believe, not too long from now, maybe even next year or the end of next year, we'll be looking at $5 a share earnings on what's essentially X cash, $40 a share. Yeah. And the cash just continues to grow. A lot of companies that claim to be profitable and the cash doesn't seem to ever show up. And then there's companies like this, they keep on adding cash on the balance sheet, hand over fist. In good times, hand over fist. In bad times, not hand over fist, but still adding cash. And that's something I like about Silicon Motion. And I just want to underline that again.
And now, a quick word from our sponsor. Are traditional expert calls in the investment world becoming obsolete? According to Stream, they are, and you can access primary research easily and efficiently through their platform. With Stream, you'll have the right insights at your fingertips to make the best investment decisions. They offer a vast library of over 26,000 expert transcripts powered by AI search technology. Plus, they provide competitive rates on expert call services, and you can even have an experienced buy-side analyst conduct the calls for you. But that's not all. Stream also provides the ability to engage with experts one-on-one and get your calls transcribed free of charge, all for 40% less than you would pay for 20 calls in a traditional expert network model. So if you're looking to optimize your research process and increase ROI on investment research spend, Stream has the solution for you. Head over to their website at streamrg.com to learn more. Thanks for listening, and we'll catch you next time. And I was going to say halfway through, we actually discuss the Samsung outsourcing and the insourcing risk a lot on the first podcast. So again, I would just refer people to that. And just last thing, because we're running long and I've actually got to get ready to get some dinner plans and get some after dinner work done. But just last thing, one thing that does strike me is Silicon Motion just tried to sell themselves to MaxLinear, right? Or this is a company now that has tried to sell themselves before. Do you think they're, 2 years down the line, the option on the specific performance plays out, the cycle kind of normalized? Do you think they're a seller again, or do you think MaxLinear just kind of bowled them over with such a big premium that they had to take it?
I have no idea. MaxLinear approaches them, not the other way around. So I don't know. It could be that the CEO is ready to retire, looking to sell. I don't know. Hard to know. I just want to end with one statement. There's one thing, going back to arbitration for just 1 second. People are understandably going to be very interested in knowing how the arbitration is going and what's doing it, and they're going to want to follow it closely, like they did with the Twitter saga. And I unfortunately will have to tell you that under Singapore rules, arbitrations are confidential. Confidential means that not the arbitrators and not the parties are allowed to reveal. The hearings are private. Nothing can be revealed about what happened. The briefings are private. You're not going to be able to see the claims or the counterclaims. And in fact, even the very existence of the arbitration itself is confidential. There are exceptions, and one of the exceptions is if they must reveal it under law or regulation. And they will have to reveal that there is arbitration undergoing. Both sides will have to reveal that as being material to their businesses. We might be able to get some information like what the size of the damages claimed is. Maybe we'll be able to see some of the briefings, but much of what's happening is going to happen underneath the waterline, and we will not see what's happening until an award comes out, which will be public again because it'll be material one way or the other.
As a New York-based person, it's actually nice to hear that because, with Twitter, I know you and I were both listening to like every hearing, and the hearings would start at like 10 a.m. and end at 1 p.m. So if you take that over to Singapore, that means the Singapore time, it would start at like midnight New York time and end at 3 a.m. And we're about to have a kid. I'm not sure if I really want to be listening to arbitration. I would do it, but I'm not sure if I'd really be thrilled to listen to arbitration. Well, Mordechai, look, this has been absolutely fascinating. I really appreciate it. I'll include a link to our first episode again so people can go listen. We talked a nice bit about fundamental value there, but we really talked a lot about fundamental value there. So people can go listen to that. I'm going to follow up on the specific performance angles, and you and I will obviously keep the conversation going offline, and listeners will just have to wait for the third podcast to hear about the results of that.
Absolutely.
But I really appreciate all the great work you've done on this, and I really appreciate you coming back on for the second time. So looking forward to the third one.
Great. Always good to speak with you, Andrew. Have a nice day.
A quick disclaimer: nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.